Oberbeck has over 36 years of experience in leveraged finance, including acquisition financing, distressed investing, and private equity. He is the founder and managing member of Saratoga Investment, serves as the CEO and chairman of that as well. So Chris, welcome. Very curious to hear about private credit and all the kind of different areas of finance that you're involved in. So let's start with private credit market. How do you see that right now?
Sure. Well, I think one way to look at the markets today is, in essence, we've got a 5% risk-free rate right now. That's what the current rate is, and the longer rate, and all that. So you can get 5% and sleep very well at night. So what do you need from your portfolio? So if you're investing in the equity market with all the risks of the equity market, you probably need to have low to mid-teens returns to justify taking the downside risk to get the upside risk relative to 5% rate. In private credit today, you can get those same returns without the downside risk if it's properly underwritten. And so, in our company, for example, our portfolio yield right now is around 12%. So we're getting 12% rates in mostly first lien loans, to credits that we think we're good underwriters, and we've underwritten very, very well. And so what you can get today, so the question is, what do you think the stock market's going to do if that's your alternative? And you say, okay, is the stock market going to be able to deliver to me 12%, gross returns, over the next several years? And are you comfortable with the risk? But private credit can give you that with a lot less risk.
Without the risk. Interesting. And that's better than our inflation rate. So you're still making money and not taking the risk.
Correct.
Okay, so let's talk about the valuation pressures that you've seen on financials, banks in particular, with the interest rate environment that we've been in over the past year and a half or so.
Yes, well, I mean, as we all know, right, we were, from 1980 until just recently, we were in a very declining interest rate environment. And right now we're in a rising rate environment. And the question is, how much more are they going to go up? And then how long are they going to stay up? And so, you've gone from having a tailwind to most financial investments, fixed income investments, real estate investments, equity investments and all that, to kind of having a headwind. 5% rate is a pretty substantial headwind relative to like zero just a few years ago. And so valuations are having to adjust. In the banking system, obviously we saw runs on banks, most famously Silicon Valley Bank, and banks have had some challenges because let's just take mortgage lending, for example. Residential mortgage lending, a lot of residential mortgages are fixed rate instruments for 30 years. And if if they did a loan for a fixed rate instrument, 2 years ago, the 30-year rate might be 3%.
That's right.
And but if you wanted to do that loan today, it might be 7 or 8%. And therefore, if you tried to sell that 3% loan today, you'd probably have a loss, approximating 30% maybe or more, depending. And so a lot of banks and financial institutions have loans like that. There's other classes of those loans on their balance sheets. But banks are able to hold that in a classification where they're held to maturity, so they don't have to mark the losses, they hold it at cost. And but there's a lot of that on their balance sheets. And if they hold it to maturity, the credits are good, they'll get paid back. The problem is the marketability if they had to market and sell it today. And so there's a lot of worry about that particular aspect, and that's kind of what took down Silicon Valley Bank and First Republic, forced their merger with JP Morgan, was that kind of concept. And so that's kind of hanging over the banking sector. Could that happen again? Is that present in some of the larger banks? There's this view of too big to fail, but even if you are too big to fail, the investors can sometimes, the bank might not fail, but the investors might have losses.
Well, that's true. And is the government in a position to come and bail out these banks again, like we did? I mean, they may not have that flexibility like they did.
Well, I think essentially they kind of always will.
They always will, okay.
So one way or another, they probably will.
They'll figure it out.
But the real question, I think, for investors is what happens to them. In other words, a banking institution will probably survive. It's the investors in their different classes of securities. Are they going to get to zero or something like that? I think that's the real concern. But anyway, so this is hanging over the financial industry. But all lenders are not the same. And BDCs like we run are very different from the banks. We've got a very different capital structure. We have permanent capital as opposed to deposits, which can leave quickly. So we have permanent capital. We're less leveraged. Banks are 10 plus to 1. We're 2 to 1 at max type of leverage. We have fully underwritten loans that we have a lot of covenants and a lot of ability to take control if we had to, or at least have a seat at the table to help guide companies, when they have problems and setbacks, and support them and that type of thing. So we're much closer to our portfolio.
I got it. So let's talk about those little BDCs, so business development companies. And you explained a little bit how that's different than the banking industry. But what are some of the ways that investors might be interested in taking a look at this? I don't think it's really well known among investors that these exist.
Yeah, BDCs, are like a real estate investment trust in that it's a closed-end fund structure. It doesn't pay taxes at the fund entity level. And it differentiated from real estate investment trusts. It invests in business loans primarily, but also business equities. And so and then I think from a retail investor's standpoint and small institution standpoint, it provides a unique window into private credit investing. Private credit, generally speaking, is the province of very sophisticated large pension funds, endowment funds, institutions, super high net worth individuals. But lower down the scale, how do you access this private credit to smaller middle market companies that provides first lien loans with low teens returns? You get that through investing in a business development company, a BDC, because that's what we do. So in effect, what we're doing is we're making private loans, but the stock is public. So they can buy a publicly traded stock. We trade on the New York Stock Exchange. You can buy and sell all day, every day, get in, get out if you'd like, and you have access to these private credits.
Okay, and these are small to middle-sized companies.
Correct.
Do you do like the kind of the vetting of these companies, or how
Yes.
do you find the ones that you invest in?
We have a team and a portfolio, and we've been doing this for a long time. And so we have a tremendous amount of relationships. We have financial sponsors, private equity firms that we work with. We have individuals that don't have funds, CEOs and the like. And we work with them to help finance companies. And so we have people out going to conferences and calling on people all the time, and we're getting a lot of feedback. And then we have transactions we've done, we get referrals. So we have this, substantial pipeline of private equity opportunities, and then out of that pipeline, we do our due diligence, and we work with the people, and it's a very involved due diligence. Our memos are like a little thesis, 35 pages long, and that type of thing.
I'm sure. How does somebody invest in one of these? They go through you, or how does that work?
You call your broker, and there's a whole industry, BDC industry, Saratoga Investment Corp, our stock symbol SAR. We trade on the New York Stock Exchange. That's one avenue, and one way to do it is just through your retail broker.
Yeah. Okay. Very interesting part. Thank you for being so generous with your thoughts and your insight into this industry. So thanks so much, Chris.
Thank you.
Thank you.